what are the rules of the game when we're trading. And there are some basic rules that are not, they're not trading rules per se. They're not statistical rules, but they're rather the rules of the market, the rules that are set or created by the fact that multiple people are trading the market, and that a small amount of people consistently gets profit and gets wins from a large amount of people that are consistently losing. And consistently losing does not mean loss after loss after loss. It means up and down, but overall the bottom line is negative. And that's very often how it's very easy to hide a profitability or not if you just add in a bit of volatility and you have a bunch of wins, you have a bunch of losses, because people don't look at it from a larger perspective. That's also why we went over looking at your performance as a basket of trades, as a basket of 20 trades, rather than just looking at one or two trades, because if you're too zoomed in, you don't see the overall picture. And the one thing that everyone has in common is that they have a basket of multiple trades. Unless you only trade one trade ever in the market and then you just stop, and for your entire life you don't trade anymore, you will trade more than one trade, and that's by definition a bundle of trades, a basket of trades, right? So there's always more trades, and that's how we need to look at it overall. So we need to understand the rules of the game, and then no matter what, we need to execute upon those rules. And if there are doubts, we look at them before, we solve those doubts before we actually trade in our planning stage, and then when we trade, we're only trading and just executing on the rule sets and on the strategies that we've set before. And that's a very, very important thing, because you don't want to change your strategy midway. If you start doing that, then bad things will happen. What will happen is that you will get incredibly inconsistent, because you're not holding you're not keeping a standard in your trades. It's all over the place. And then because it's all over the place, by definition, it will be unprofitable, because the line between profitability and not over the long haul, meaning that over more than 10 trades or 10 trades, the important part there is that you are consistently taking advantage of an edge in the market, and you're doing that with a low volatility. If you add in high volatility, then by definition at some point your account will drop too low for you to recover, or too low for you to recover in a reasonable time. And then either you will always just be slightly underwater no matter what, because anytime you get back to break even or slightly above, you just have another loss, and then just working your way back up, and you're consistently slightly underwater. Or you start revenge trading, and that's good night very quickly. That just blows your account very, very quickly. So if you're a bit more emotionally mature, you're probably not going to blow your account, but you will still struggle with being consistent. You'll always be slightly underwater, because you're not consistent enough in taking advantage of that edge. And the edge is covered in a lot of noise and volatility. So the important part is there that we're very consistent with the edge, first of all, and we're good enough with understanding the fundamentals of the market, so we can always execute it as we're supposed to. So some basic rules of the game, right? Number one is the market's trying to trick you, always. Because when you look at the market like this through TradingView, by definition, unless your performance is otherwise, by definition, you're a retail trader. And what that means is that all the information that you're getting, other people are getting as well. And because of that, what you're seeing, the main purpose of what you're seeing is to trick you to do the wrong thing. And at this point, so we already established that it's a zero-sum game, meaning that for someone to win $1, someone needs to lose $1, right? And the people that make money consistently are very good at it, and are very smart, and it's you're basically competing against one of the smartest people in the world. And on top of that, with AI, with automations and all of that, they have so much extra abilities and extra perspectives that they can look at the market, where a chart itself already puts you at a very, very high disadvantage. That's why we're trying to help with, different indicators. We got Porcupine, we got different scores, we got the dashboards, we got our strategies in the dashboards, distributed, negatively correlated, and so on and so forth, right? I mean, that's part of it. And by far the most lucrative method that we're using, that we're trading, are the dashboards, because they're slow trading. Like this bundle has a trade, with all the strategies trading at the same time, they have a trade every day to every 2 days. So once every 1 or 2 days is when a trade entry happens. So it's not that often, but it's so consistent that no matter what happens, it just keeps going. And that's the thing. The dashboards themselves, they're not looking at a trading chart, right? They were actually pre-processing our own data, and then we make decisions off of that data. And if we and we did that many times, if we take our strategies and we put them on a trading view chart, they're not even close to being as profitable as they are, with our pre-processed data. So that's a very, very important part, is that you need to understand that, first of all, what you're looking at, the market's trying to trick you, because most people are looking at the same thing. So by definition, people, and this is something that's very, very interesting. When you talk to someone that is very, very successful in trading, or has been around for a long time, for them that's obvious. For them that's something intuitive, that they're looking at a chart, and they're looking at a chart not as we just hit a support, we just hit a resistance. The way they look at a chart is, people might think that this is a support, people might think that this is a resistance, and this is literally how they talk. When you ask them to interpret a chart, they don't say what they think, they say what they think that people think. And that's a very important distinction, because they might think that the price might go somewhere else, but they might think that people think something completely else, and that's where your arbitrage happens, right? That's where your delta happens, where you can make profits. So that's a very, very important thing. So number one, the market's trying to trick you. Number two is, you will feel emotions, and that is okay, but you cannot act on them. And that's the thing. The best rule of thumb is that when you trade a strategy, and when you're in the process of trading, your best reaction to something is nothing. You don't want to react to the price anyways. My favorite way of trading, and I usually trade that way, is that I set up a trade, whatever the setup is, and I put my orders in, I take profits and stop losses there, and then I just don't look at the chart. I do something else. I code, I do something else. And then a couple hours later, I check back in. And what happens is, well, obviously, either my trade plays out or not. If it plays out, great, I look at why. If it doesn't play out, fine, I also look at why. But now I get to look at the trade looking back, and I can look at it objectively. Because if I look at the trade as it's happening, there's going to be so many emotions going through me as I see the bars going up and down on all the different time frames, going to the 1 minute and seeing the big movements. At the end of the trade, looking back at it, I will interpret it completely differently, because there were so many emotions, so many experiences that I had in that trade, which are not wanted. So what would work much better is that, if I set it up, either way when it goes, it's taken care of. And then I come back and I can look at it objectively. I'm like, okay, well, it hit my stop loss. My stop loss was too tight, or my take profits were too low, or too high, or whatever it is. And I can look at it objectively. And people might not like to go or not look at the trade while it's happening, but if you have your stop loss there, if you have your take profits there, if 100% of your position is taken care of with some orders, then you can absolutely do that. And that's something that I prefer to do, because then I don't have to worry about other things. And that it's much easier to do it that way. Actually, paradoxically, by far the most amount of money I made in trading was during a time where I barely looked at charts. And that's true. We were in Croatia renting a yacht during a yacht party, and then we went to Marbella, and we were so hungover that we were just chilling for like 2 weeks. And all we did was look at the chart maybe once a day for like 15 to 20 minutes. We were trading higher time frames, but the principle is the same. Because every time, we looked at, the stochastics developed this way, the stochastics developed that way, and we're still waiting for our short, or we're still waiting for our long, and that's it. Next day we come in, we're still waiting, all good, that's it. Next day we come in, the short happened, great. How are our take profit levels? We're probably gonna hit our take profit level today or tomorrow, great, that's it. Next day, we hit our take profits, great, that's it. Next day, no trade. Next day, no trade. Next day, okay, we might have a long here soon. And that's literally what was happening. And we were, on our laptops, or like we were trading. I was on my laptops actually more because I was developing, but purely trading, like the money generation in trading was like 15 to 30 minutes a day. And we averaged around 200 to 300 grand a week in profit on that account. So it works, right? And the thing is that paradoxically, the more you look at it, the more you overcomplicate the simplicity of it. And truly, it is simple. And the more we look at it, the more we overcomplicate it, the more we find stuff because we're trying to see stuff, not because it's there. Because when you look at something and you only have 30 minutes to look at it, you see the obvious things. When you look at this, for example, when you look at a painting. So when you look at the painting in a museum and you're just walking by, well, then you just see the obvious things, right? And you cannot really say, okay, is this a standard painting or is this a $100 million painting? You don't really know. But if you stare at it in front of it and you look at it for 2 hours, then you'll be able to see the difference. In this analogy, staring at it more and looking at more detail is not good, right? You want to see the obvious things, because the more you go into detail, the more you overcomplicate. And the truth is that the trading patterns, they're simple. Same with our stochastic strategy, right? It's simple. It's literally up or down. Are they together up or are they together down? That's it, right? But because, we add in so much more stuff into it, it gets more complicated. And then obviously risk management and mindset are two completely different things, and trying to code it is also like it adds in a lot of more complexity for obvious reasons. But the core, or like the complete base, is that it's simple. And that's how you should be looking at the market, because when you start overcomplicating, the one time when I know that someone's not trading as well as they say is when they start giving me 2-hour lectures about the technical movements of a market. Like I listen to that and I'm like, I'm 100% convinced that you broke right now, because like when you have to when people don't understand something, they overcomplicate it. So when something's extremely complicated, well then that is probably a problem. Like our strategy, right? We have stochastics at the top or they're at the bottom. That's it. When you look at different time frames, it might be hard to remember all those time frames. So we made an indicator that looks at the scores of those on one chart. That's literally all there is, right? We understand how the strategy works. When we're trading in a range, then it works the best. When it breaks out of the range, the stochastic is going to be topped out and it will stay topped out. We need to wait until it starts ranging again, then we can trade again. That's it. That's your $1 million strategy. And then, all you need to do is start practicing it and getting it into your muscle memory, and you will get the consistency out of it. But what's important is that understanding it and the simplicity of it is one thing, but then the other thing is staring at it on a 1 minute time frame and going through all the emotions and then reacting on those emotions. Still, my favorite example for this is, and this is something that really happened, and it wasn't about pennies. We were literally trading with millions of dollars. And this happened, is that we were trading and someone I was looking at, they were trading and they were shorting. And they were waiting for a couple of days, and then their short finally played out. And as it played out, the price started like falling, very similar to right here. Started dropping, and their take profit levels were like perfect. They were like right here. They're like just about, to get filled and exit a couple $1 million. Very good. And as the price was dropping, what they did was they removed those take profit levels, because they were like, oh, it's dropping so much, we will go much, much lower and we'll make much more money and, get all excited and everything. Well, guess what happened? The price wicked down and then went the opposite way and up. And while that person was correct in the trade, the emotions took over and they did something that logically makes absolutely no sense. And it cost us a couple $100,000 and essentially for no reason. The reason was the emotional triggers. So rule number 2 is you will feel those emotions. That is okay. You just can't act on them. Whenever, and the part of you can't act on them assumes the fact that you have taken care of, or like you have taken the responsibility of looking at the market, your strategy, and everything before you enter the trade. So let's just assume that I'm longing here, right? Random. I didn't look at anything. Let's just assume I'm longing here based on some indication that we have. Okay, so here we're, towards the middle of the range, and let's assume that, I'm looking for a long, for a new price discovery locally. So I want to beat the higher high and go at least say half over the higher high. So what I'm projecting based off some analysis that I did before is that we're gonna long here, and we're gonna long up until 49.9 or something like that. All right, great. So this is my long, right? So this is what I want to do. Now I need to look at this trade and I need to set it up to account for all possible scenarios. And if I do that before the trade, what will happen is that when I'm in the trade, I am not triggered to do any actions based on emotions because I solved those problems beforehand. So what I'm going to do is like, okay, well, number one is where can I put my stop loss? So we're very volatile right now. And while I assume that we could bounce here, we could also go much lower. So what I need to do here is I need to put my stop loss lower. And as the stop loss is that much lower, what I need to do is I need to split up my entries, maybe enter with only like 20% right now, and add in a couple of layers here. I put in a lot of lines here at this point, so let me just delete some so it's easier. And I'm gonna put in a bunch of layers here. So this way, you know, as we keep going down, we'll start picking up orders, and you know, if we hit, say, the lowest order, our average order would be like somewhere here, which, you know, in which case you're like somewhere here, which would, you know, be a great entry. So that's number one, right? When we enter, we need to end. Honestly, when I see this dropping like this, like if I, for some reason, I would have the conviction that we'll bounce, I would enter with a small amount here and with a large amount at those layers. So that's number one. Whatever happens towards the downside now is taken care of. I will enter more, exit. That's what probably below here. So that's taken care of. All right. Number two, this is my projected take profit, 49.9. All right, great. Does it have to go there? Absolutely not. What other supports and resistance levels do we have here? Well, we have this level here, which is the previous high that got, you know, that bounced a couple times. We got another, obviously that's right here, and then we got one right here. All right, so now we have 3 take profit levels. So now, assuming that at this point I will take 100%, or what I could do as well is I could wait till I hit TP2 and then put my stop loss to break even. I could do that too, and just put a signal on this line and alert me whenever I hit this line. And at that point, I just come in, put my stop loss to break even, go, then, you know, do something else again. But at this point, towards the downside and towards the upside, even if I wasn't in the trade right now, I can literally just put in the orders, and on those orders, I can put a take profit and stop loss already. So before even entering, assuming that I didn't even enter now and my first entry is here, I can set up these orders and I can leave before the trade even entered in the first place. Because towards the downside and towards the upside, 100% of the position is secured. So at this point, I can literally just leave it as it is. In my head, this trade is done. This trade is stamped up. I can do nothing about it anymore. I can look at other trades. I can do something else. And a couple hours later, I'll just come back here and I check back in. And what will happen is that your trading performance will go up a lot. Because if you look at you know, your trading performance, and if you would look at your actual orders, like this granular orders that you're executing in a trade, I'm sure that in many trades it would look very messy, of like a lot of orders in, a lot of orders out, back in, back out, and just like a lot of messy movement, you know, which, by the way, all of them lose you money. So instead of doing that, I can set it up now, come back later, and the execution will be much cleaner as if you were actually there. Because the chances, like more often than not, your execution will get worse when you're looking at the price. Rather than if you set this up, you leave and then you come back, well, guess what? 0% emotions were involved. When you're looking at the price, emotions are involved. Even now, when we're looking at this price dropping, I'm sure some of you guys are looking at it more and more because it's going lower and lower, right? If you weren't here though, that wouldn't happen. You would just come back, you'd either get stopped out, or you would hit the take profit, or you would be somewhere in the middle. 3 scenarios, right? If we hit the stop loss, it's accounted for in our strategy, and the percentage that we lose is exactly according to the strategy. The take profit is a large multiple over that loss, and we're trading a strategy that has a high high hit rate, meaning that we're right more often than not. The math is there, the theory is there. Right now, we just need to execute it. We need to make sure that the execution is as precise as possible, and the most precise it can be is when we're not around. So that's something important. So the best strategy when trading is don't react. Very well, you can just not be here and not look at it, and then by definition you cannot react, which actually very often is good. And I've seen that also many times over. I've seen it myself, I've seen it with other people. When they were looking at charts less, they were making more money, because the setups are clear, and then you just leave and you don't overthink it. If you overthink it, that's when the problems happen. And that's also when, think about any time when you had a big loss when trading. Were you there or were you not there? Most likely you were there, because when you were not there, before you leave the chart or before you leave your laptop or your phone or whatever, you make sure that you're secured. And no matter what happens, if you're not there, you'll be fine. That's the first thought you have. So by definition, you're actually more consistent and more secure if you don't look at the chart rather than when you look at it. And the best way also, a very good way to execute on this is, even if you're not, leaving, is that you need to think about, you trading, you need to think about it as a company. Because that's what it is, literally, it's a business, right? So think about it as a business, but think about it as multiple people. There's multiple people in the business. It's not just you as one, it's multiple people within the business. And there's two departments. There's the strategy department, and then there's the execution department. And those are two separate departments, and they have two completely separate jobs. And you as a person in that business, well, guess what? The business is you. So it's your responsibility to do both those jobs. Not at the same time, but you need to do both those jobs. So the strategy part is you backtesting, is you working on a strategy, is you looking at the historical data, analyzing live trades, live results, learning, listening to live calls, whatever it is. That's the strategist part. And what the strategist will do is it will write down a set of rules and the strategist has a, day shift, and the execution department has a night shift. So what will happen then is that the strategist will write down a set of rules for the execution department, where there's a bunch of workers. And it will write down a set of rules on paper, and then the strategist will leave because their shift is over. And the execution department takes over. And now, when you're trading, when you're actively trading, that's the execution department, that's the workers. And all they do, they didn't hear what the strategist was saying. They did not, follow the logic behind it. They just have a set of rules, and without thinking about it, they're just executing on those rules. Without thinking about it. And because of that, the overall business is going to be much more effective, because there's two parts that are doing their job and they're not mixing together. Because then the next day, the strategists will come back to their shift, and what they will find will be a list of live trades that happened with an analysis of it, of what happened. And now the strategist can take it as feedback and work on a strategy again, and make another set of rules, leave it there when their shift ends. And then the workers in the execution department can take over again and work on it and just execute again. So the execution department literally just does what's in that set of rules and reports back. Those are the soldiers, right? They're not paid to think. They're paid to do what their job is. Those are the soldiers. And then the strategists are essentially the generals, where they're paid to think about strategy and think about how to execute those orders for the goal that we have. And they will get a report back from the soldiers, from the execution department, on how it played out in real life, and then they will adjust their strategy again and give a new set of rules. And that's how you improve your strategy. You don't improve it on the fly, you don't improve it while trading. You need to actively separate those two actions of executing and trading and strategizing and building your strategy. Those are two separate things. A strategist can look at historical data, can look at charts, all of that. But when you're trading with the goal of making money, at that point you need to know exactly what you're doing, and the rule set needs to be there already. If it's not, then you're setting yourself up for moments and situations that you cannot handle, that you will trigger emotional reactions, and that you will eventually lose on. Even if it doesn't happen this one, the next time you'll be, oh, I was lucky this time, this one's fine. But think about it as if you did that 1,000 times on 1,000 trades. That's how you need to think about it, because it's all probabilities, right? And when you think about something like, okay, I just made this action, I just FOMO'd into this trade and it played out well, thank God. Maybe FOMO isn't that bad. Well, yeah, but if you play it out over 1,000 trades, you will end up with 0 at the end. And the reason, well, because you're just too volatile. So what you do, I love to think about it that way. Like, that's any situation, like in life, like, okay, this decision or this action, like if I did this 1,000 times, what would the result be? And really what it is you just extrapolate, or you just multiply the action by 1,000, basically. And then you see, if you weren't sure if it was slightly good or slightly bad, you would see the impact. Because what will happen is you will trade 1,000 trades. So the way you trade, or the habits that you have and the rule sets that you have, will affect all the coming trades. And this is something that you will see, like for the people that will go over like building strategies and so on and so forth. Like you will see that once you backtest, you will see how small changes in your strategy have a big impact, and changes that you think are small or you think are not that important literally make or break your strategy. One of them is, well, obviously being volatile and human error. That's something that has a big influence on strategies. So it's important that you separate the thinking part with the executing part, and you switch, like you throw the ball from one side to the other. There's never both sides working at the same time. If you're focusing on strategy, you have no place of live trading. If you're live trading, you have no place of building your strategy. Those are two separate things. Both of them need to happen, but never at the same time. So, rule number 1, the market's trying to trick you. Rule number 2 is you will feel emotions, and that's okay, but you cannot act on them. The best strategy when trading is don't react, just follow the rules. And you're two different people, you're two different segments in the business. You're the strategist and you're the worker. And it's your responsibility to do both of them, but at separate times. And that's what's very, very, very important. You don't want to do both at the same time, because that's when problems occur. So the rules are, the overall rules in the market are known. We've covered them many times over. The important part is that we need to execute it. And also, when we have a strategy and we have doubts in that strategy, we need to look at them beforehand. So what's an incorrect way of looking at it? The incorrect way of looking at it is like, okay, there's a strategy, I don't understand it, or I have a doubt in this situation of that strategy. I guess I'll just trade it and I'll see what happens. That's not good. What you want to do is you want to, when you have a doubt about a strategy, look at historical charts, see that situation, see how it played out. Did it play out well? Did it not play out well? Either way is fine. If it doesn't play out well, we need to handle it somehow. Okay, if there's always a chance of this happening, we might have to risk less. If we can identify of this situation happening before it happens, or in the middle of it happening, then maybe we can risk the same amount, but we just don't trade during that time. Maybe there's another indicator that will help you filter it out or work with it, or even take it into your advantage. That's one of my favorite things to do. Whenever there's a weakness on a strategy, I like to flip that and somehow create an advantage out of it. What happens a lot too is you can literally build a second strategy that is essentially built around the opposite of the first strategy, and whenever you would be losing, you're actually winning more on that other strategy because it's optimized for that situation. And that is something that we do in the dashboards, by the way. So yeah, those are the important parts. And when you're trading, the most important thing is separating it. And when you're trading, you need to understand the KPIs, or like the indicators, not technical wise, but performance wise, what performance you look at. So when you are building your strategy, then what you look at obviously is, once the workers are done, what you look at is you look at how the strategy performed in the live market. You take that data and you work with it. What worked well, what didn't work well, what can we improve, what can we leave, what do we need to change, what do we need to drop. On the execution side of things, with the workers, your performance indicator is, did I follow the rules and did I execute on the rules the way I'm supposed to? If the strategy is bad, or like if there's some problem in the strategy, but you're in your execution stage, you're in the working stage, and you executed every single trade exactly like it said in the rules, the worker did a great job. Even if he lost money, the worker did a great job, because the job of that side is to execute exactly on the rules. And now on the strategy, it's clear that the strategy is the problem and you can work on it. If you have it mixed up and you lose money in the market, you don't even know if it was you not executing the strategy or the strategy not being good enough. You don't know, because you don't separate it. And same thing is if it works. Did it work because the worker did not follow the strategy, or did it work because the strategy worked well? You don't know. So that's why it's important to separate it and have one as a strategy and one as the worker and the execution part of things. And when you're executing, your goal should be, I want to execute 10 trades exactly according to the rules. That should be your goal. And then your goal when you're on the strategy part is, I want to, backtest, 10 trades with a given performance or something like that. So those are the KPIs. Those are the things you want to look at, and you want to look at it as two separate things. And very often what hedge funds do, or what many companies on Wall Street do, is that they have two separate people doing that. So they have, obviously, right? I mean, they have strategists, and then they have traders that execute exactly on a strategy. And that separation helps the data flow and the cleanliness of the data and the performance. Because what a strategist will always do is he will always try to analyze the strategy and tweak it also when he's live trading it. And what a worker will do is, well, not, develop the strategy further. So you as a person, because you're not on Wall Street, you need to do both things, but you need to consciously think about doing them separate. And when you do them separate, you should actually have two different tracking sheets, one for the strategy part, the backtesting part, the development part, and one for the worker and the execution part in live trading, and that will help you a lot. So yeah, and then once that doesn't mean don't trade live. Like, you need to trade live, because the live data that you get off of a market is much more valuable than historical data. So whenever you can, just start getting live trade data, even if it is with $10 or something like that, because then you will get actual live, behavior and live performance data. And then with that, you can take that back, and then you can analyze it and work on it. And then analyze and work on it whenever someone sends some data, some trade performance in the Discord with, with the trades plus notes for every single trade. I'll be more than happy and analyze it with you. Analyze it the same way we analyzed it in order to create the dashboards. Same exact way. More than happy to do that. All you need to do is get that data and, either backtest it or have live trading data. Do live 20 trades, put them together, put them into a sheet and send them in. And once we look at it over together, I promise you will have a good strategy. So those are that's what I wanted to cover today mostly. These are the unspoken rules in the market, right? The market's always trying to trick you with emotions. You will feel those emotions, and that is okay, but you can't act on them. The best strategy when you're trading, when you're executing, is don't react, right? Only focus on your rules. Whatever else happens. The best way to do this for me is to set up the trade and leave. Even here, right? So right now in this hypothetical trade, we hit two orders, right? So our entry would be somewhere here, right? If we were there, and we were here, this chart was open. When we were here and the candle was going, further down, and it was all red, we could have already panicked and done something, done some emotional reaction in that trade. If we just set this trade up and did something else and came back a couple hours later, most likely would have a better entry and a better exit than we would when we're live looking at the charts. Because there's just emotional triggers connected to it. They're there for a very, very specific purpose, which is to trigger your reactions. So the best strategy when trading is to don't react. And when trading, you're two different people, two different strategies. You're the strategist and you're the worker. And you want to keep those separate as essentially as completely separate departments in a business. And the interaction between those is what's going to create the value and create the performance that you actually want to have. Right. Great point, Pato. So when you don't check the chart, you will. So think about it this way. What do you need in order to execute a trade, right? You need to put in a entry order and a profit order and a stop loss order. That's all it is. That's three interactions that really are needed for trading. And every single time you look at the chart, extra than that, the only thing that you do is you add in more possibilities for yourself to add in more input into the trade where it's not needed anymore. So it will make the performance worse. And when you look at it and when you watch the trade while the trade is happening, like, it is literally there to fake you out, to trigger emotions. So just setting up the trade based on a strategy and coming back later is the most constant way of trading your strategy according to the rules. Because when you're in it, a lot of stuff can happen, and it can move up and down. And guess what? When you're back testing your trades, you don't see the live movement of those candles. You don't see this big pump of that candle that's happening within a couple seconds or something like that. You don't see those things. So you're not ready for that when you're live trading. When you're backtesting, you just see historical data. So the best way of replicating that is going to here, saying, okay, this is an entry for me, set it up, and that's it. And then you come back when it's already historical data. And at that point, you're actually very, very aligned with your backtest. So psychologically, it's a huge, huge deal. It's a very big impact psychologically, rather, as opposed to being there and watching the trade play out, which is very, very problematic on a lot of levels. So rather looking at it, seeing the setup, setting it up, making sure that 100% of your position is covered to the downside and to the upside, and then leaving and coming back a couple hours later. Just try it out, and I promise you, your performance will be much, much better than if you were staring at that 1 minute chart. So, good point. That's all I wanted to cover today, by the way, guys. If you guys have any questions, let me know. Feel free to write them down right now. And other than that, as always, you guys can ask in Discord. So for risk management, it depends. So how do you manage risk? So when you manage risk, it's your risk management should be clear before the trade even happens. You should know exactly how much you can risk maximum in a trade. And there should also be a clear stop where there's a clear invalidation of that trade. So if you keep checking the price more, what that means, or what you're implying by definition, is that with the more data that you have, somehow you might be changing your risk management strategy, which is okay, but really the risk management doesn't change whether you're in a trade or not in a trade, because the risk management happens before the trade, saying, okay, the maximum I'm willing to risk here is 7% or 5%, and this is what I build my trade around. So say I want to risk 5% maximum. So here I have my stop loss at 2.6%, and then my average entry would be around here. So it's at around at 1.8%. So if I want to risk 5%, then I can probably I don't know, how much is that, guys? I could probably go in with 4x leverage, not even 3x leverage. Around 3x leverage. So I could go in with 3x leverage right now. So I set up my leverage to 3x. I go into this trade. My average entry right now is around here, and I would just go on off probably the average entry that we would have, and I'm setting it to 3x, and the worst that can ever happen in this trade is that I will lose 5%. What I will do though is, if I hit a TP level, TP1 here, which is a resistance level by itself, if I hit this, I will alert myself. And when I hit this alert, I will put my stop loss to break even. And at that point, I took some profits, and my stop loss is at break even. So I'm guaranteed profits in this trade. No matter what, I'm walking out of this trade with profits. And when I do that, then that's risk management, and that's, yes, interacting with the trade while the trade is happening. But the way to do that is I predefine, before the trade happens, once again, I predefine when I make that decision, right? I don't make it randomly. I put a line there if I hit that line, I alert myself, and only when that alert happens, I can adjust the trade. I don't adjust it ongoing without any definition. I define it beforehand. Yeah, so you should for sure, Pato, you should for sure watch the risk management video that we have in the challenge. You should probably just watch the whole 5-day challenge, but definitely the risk management video, because that will explain a lot there. So so yeah, you need to calculate the risk that you're willing to take based on your strategy, based on how your strategy performs. That's how much percentage you can risk on a trade. And then based on the percentage that you can risk on a trade, only then you can build out the entire trade, essentially, with your leverage and so on. So all of that are calculations off of the percentage that you can risk per trade. So yeah, watch the risk management video on YouTube, and I think that it will help you a lot. Long on Bitcoin right now? Oh yeah, no, I was just that was just a hypothetical long. Really, I didn't even look at didn't even analyze the chart. I just threw out a long because we were talking about it. I'll send you the link later, Pato. Okay, guys. So this was all that I want to cover. Let me see if I don't. Yeah, if you guys have any more questions, let me know. Thank you for showing up, and other than that, I'll see you guys in the Discord.